what's up, guys? Long time no see. I've been busy doing other stuff. My brain is creating too many wrinkles, so I'm just, chilling. But anyway, so, what else do you guys want, right? Listen to this, okay? You got the bonds market liquidity. You tell me what liquidity is better or greater than that. Tell me, please. Come on. Tell me. If you pay attention to the bond market, you know what the fuck bonds are, and you know why they're bonds and how they're created in the secondary market and the primary market, then you would understand the importance of the bond market, right? Having said that, understanding the exact point and location of the bond market POI, liquidity, and volatility pocket, all right, which is the bonds opening range, right? The thing about the bonds opening range is that those PDRAs within that range hold more volume. They are much more well respected in the bond market, right? So if those PDRAs are going to stay put or intact or respected in that range, there's going to be that range in itself, in terms of premium and discount, is going to be heavy, right? So if you study the bonds opening range, which is from 8 a.m. to 9 a.m., you're going to start understanding and seeing what the fuck is really going on, right? So you have an opening of a week, which is an NWOG, right? The NWOG is a magnet and it's a launch pad, okay? Why? Because volatility and volume are there. Why? Because that's a point of equilibrium. See, when the algorithm is resting at equilibrium, it wants to leave equilibrium, right? That's Asia, right? So the bond market, the bonds opening range is the same thing. It's an equilibrium level where there will be and is a premium and discount, right? So if you approach it in that manner, that pocket of time is going to hold the PD arrays that you want, right? And all you have to do is understand how it works, which is, okay, if ICT already told you that he doesn't let his son trade before 10:45, there's a reason why. There's a look back at 10:30, which is manipulation, and that is after a previous manipulation of 9:30. So now we have two manipulations, right? Aside from the 8:30 manipulation. So we got like three manipulations that we take into consideration, right? And the PD arrays within that range are going to be your key, right? So you got the PD arrays, but you also have the liquidity. So what you got to study is the model in terms of its PD arrays liquidity. So, okay, liquidity. What happens at liquidity? So if you want to get like into more detail, then you go into this SMT, right? Yeah, you do, because that bond market is going to hold the liquidity that the market likes to purge, and therefore there could be a lot of SMT in that area. It's not necessary, just for those that like that kind of confirmation, right? And or just to study it. So the bond market has the opening range, and then so if you study it over and over and over, you're going to see that there's always an expansion away from there, right? Now, the PD arrays have to be, if it's bullish, certain PD arrays will have to be respected, right? So you could pair that range with the London range that I shared, right? You could pair those ranges in terms of premium and discount as well. So like if the bond market, the bond opening range is at a premium, right? High time frame premium, monthly, weekly, daily, and intraday, then of course you're going to look into that bonds opening range for a PD array, right? To take price lower into a discount of the daily range, which would probably be London under, right? Like London would be under, and or the liquidity under London, right? So the point here, to keep it simple, is if you use the bonds opening range every day and you understand the PD array matrix, then you're not going to have a hard time trading that at all, right? Because you're going to understand that, first of all, right after the bonds opening range, there's a 9:30 manipulation, right? After that manipulation, you already have your PD arrays within that bonds opening range, like there. You have them, notated. So once you see that 9:30 manipulation, then you could start, going from there if you want and playing those PDRAs accordingly, right? Understanding that by 10:30 there will be another manipulation, look back manipulation, right? So then if you put it together, you're like, all right, well, let's see. What's towards the end of the bond market opening range? Well, that's the 850 to 910 macro, right? Which then creates a silver bullet that goes into 1050 to 1110, right? And within that pocket, in that window, there's a 1030 look back, right? So you could either play the bonds opening range and the 930, manipulation off those PDRAs, or you could wait till maybe there's a draw on liquidity, right? Which a lot of people prefer to wait for because, the stronger PDRAs are off liquidity. So just imagine the bonds opening range already having so much liquidity and volume, and then that bonds opening range, there's a purge of let's say, for example, the sell side, right? So that's pretty significant, right? So because, those high probability PDRAs are going to be created in that draw liquidity, right? So you pair that draw liquidity with so let's say they rate the lows, the bonds, opening range lows, right? They got rated. And then you notice that, we're moving a little higher. Then what you're going to do is you're going to want a bearish PDRA within that bonds market opening range to be violated, because then you already know that we're going higher, right? So if you see that as a confirmation, then you just go from there, right? You could do that. So there are many ways to approach it. The SMT obviously will give you like ICT says, right? It will give you like a confirmation that we're not going lower. So if there's a purge of the bonds market opening range for ES, but there's SMT with NQ, NQ showing a higher low, right? As we go higher for like a bullish move. Well, then there you go. That means that NQ would probably not go lower anymore. So you want to trade the strongest one of both, right? Which would be NQ. It's showing the strength. So that's how you use SMT, right? As a tool that pretty much, if for that entry, which is, there's only two things that happen, as ICT says, right? It's that same model, which is the SMR of a buy or sell model, right? So basically what I'm saying is, if you look for an SMR of the liquidity of the bonds opening range, if it rates the lows, then that's a good way to start, right? And using SMT and all that, obviously it takes work and attention and study. But if you just want to use the PDRAs, you can, because obviously you already have like your sentiment and directional bias according to the higher time frame, right? And that's when you also have to understand that looking at the PDRAs 3 days back is important, right? Because you want to base your intraday off those 3 day back look back of your PDRAs. So if you have a bullish order block, high time frame, and then you have the bonds opening range in the 5 minute, and a bullish order block in the daily, for example, then we're in that order block, or at the wick of the order block, which is still considered the order block. Then you're looking at the bonds opening range, right? And you already have a target. You could do the low hanging fruit, right? You could do the like nearest highs, which should be used as support once they get there's a break of structure, market structure shift on the way higher for a unicorn, because the unicorn is going to be off that high, that the break of structure high. To the left is going to be the breaker. So anyway, but if we're looking at it high time frame, all you really need is a 3 day look back, liquidity, and PDRAs, right? And then you pair that with the bonds opening range, and the bonds opening range is always going to give you the volume and the liquidity and the PDRAs. That's what you need to understand. And you could pair, if you like analyze that, you pair it in terms of like where you are higher time frame for the intraday, which would be like a premium or a discount. And then you have yourself, like, if you want to target, let's say you're bearish because we're at a premium for the day, and the bonds opening range opens higher, and you want to be like bearish, you want to trade to the downside. Well, obviously London, first of all, is going to be a target for you, right? Because each session you got to treat as like a daily AMD. So like the same way you look at a daily candle 3 days back, you could look at 3 sessions back, right? So if you're looking at 3 sessions back, you're going to be looking at London, Asia, and then New York of the previous day, right? So you could do that, or you could just focus on the one session look back, which would be the volume, and it holds equilibrium, which is just like the NWOG, right? And it's all fractals within fractals. So if you were to approach the bonds opening range as an NWOG that has uh, that has a midpoint of equilibrium, and you want to look at the bonds opening range premium arrays. Let's say there's obviously a SIBI, right, in the premium area. So if you got a SIBI in the premium area, and and the algorithm's like painting through it, and it just completely disregarded it as resistance, then you got yourself a trade, right? But to keep it simple, the bonds opening range PD arrays is what you want to focus on, right? Because the first thing you're thinking is, well, I got to have my stop loss, et cetera, et cetera. Well, obviously, if we're using the bonds opening range and you notice SMT, that low is obviously protected and is good for your entry, right? Assuming you're entering the stronger of the two. You're entering the one with the higher low, and not the one that purged the lows, right? That's one scenario. But other than that, if you simply just are bullish because of the news and everything else, and there you go. The bonds opening range is a good starting point for a new person, right? Because I just like literally narrowed it down to particular PD arrays within 1 hour, right? So you got that 1 hour between 8 and 9, and then right after that hour ends, there's a macro. Now you're thinking silver bullet, right? You're thinking silver bullet right after 8:50, and obviously there's an 8:30 macro, right? So now we got an 8:30 macro, 8 to 8:30 macro, is it? And so that's in the bonds opening range, right? So if there's a macro inside the bonds opening range, you're already thinking draw liquidity. So you're going to know that draw liquidity, if there is one, between 8 and 8:30, because that's a macro, right? That 8 to 8:30 might draw liquidity as a turtle soup and then create a PD array, right? But you're focused on the PD arrays after that whole range. So you're focused on the PD array that's within a macro, 8 to 8:30, within the bonds opening range, which is 8 to 9, and the premium and discount. That's all you're doing. That's literally all you're doing. You're just focusing on those PD arrays, because if you're bullish, a PD array at discount should not be violated. You already have your discount and premium. That's it. You have it. That's it. All right. So if you are bullish, the discount array for the bonds opening range should not be violated, dude. Do you understand that? So if that bonds opening range is at a premium for intraday and it gets violated, that discount array gets violated, guess what's going to come in there? The opposite volume of that discount array, right? Which is selling. There's going to be, the algorithm is going to go lower. It's going to deliver price lower into what? The previous session, which is London. So all you're really focusing on is, okay, I have high probability PD arrays within the bonds opening range already, because these PD arrays are in a high volume area of time. And the market likes to purge the liquidity around that bonds market opening range. What's our evidence that that's true? Well, ICT himself said for his 2022 model, isn't it 2022? Yeah. His latest model, right? What does he say? He says, you want to wait for liquidity to be taken out. What side gets taken out first? left of 8:30. Correct? He says left of 8:30, 15 minutes back, left of 8:30. He's literally talking about the bond's opening range. That's what he's talking about. So if you have the bond's opening range, and then you have the fact that ICT has said, for the latest model that he shared on his YouTube, not the charter stuff, but the later model that he did for his daughter. That you're putting it all together, so it's making sense, right? Now, what was happening is you were using the PD array, which is literally the higher, more volumes packed PD array that obviously would be after a drawn liquidity, which is that model that we're talking about. Takes out the highs, creates a breaker, and then goes lower, right? However, instead of just looking at it in terms of I gotta, that's the only way I could look at it. What you could do is use those PD arrays within the whole hourly range for that model. So now what you're doing is, let's say you don't enter right after the breaker at the premium is created in the bond's opening range, which is pretty much that 2022 model, right? You could still enter at the discount array that gets violated, correct? Now, what's going to be created around that area of the discount that gets violated? Another turtle soup sometimes. So what I'm saying is, let's say you have a bond's opening range and it has its high and its low, and then the algorithm runs higher, takes out the liquidity. Let's say you have relative equal highs or just that high, and it takes it out, and we're at a premium because London's way below us, and we're at a premium because it's already Wednesday of the week, and we're way the fuck up here, right? Or Tuesday. So now you're thinking, I'm going short because we're at a lot of premium here. So let's say that's the scenario. So then let's say it purged the highs and then it went lower into the range, the bond's opening range. The first thing you're going to look for is if there's resistance off a premium array within that range, and if there's a violation of a discount array within that range. Now, when there's a violation, it could still create a high within that range to the right of it. Let's say it's already 9:30, 10 o'clock. Let's say there's a high within that range or near that range at its lows, and we're going lower, and there's a high. Well, 10:30 is a look back, right? So now you're thinking that some of those highs within that range are going to get turtle soup, right? So then you could approach it like that as you pair that liquidity to that discount array that you want to see stay violated, right? So really, you could use all of those factors, but really, 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 to make it really easy on you, all you got to really focus on is the PD array within the bond's opening range that you want to be respected or violated, and to stay that way, let's say, for example, on the way down. Now, this is where time comes in even more, because then if your trade is taking too long to come to fruition, then that means you are gonna be like, you know what, fuck this shit, and you're gonna leave. That's it. But you want to see that energy, right, for your trade. So that there are a lot of factors that come into a trading plan. But I would say that if you know where the highest volume PD arrays are at, and you analyze those ranges, and you day in and day out understand their purpose, right? Because the bond's opening range, what's there? Tell me, what is there? There's a lot of manipulation. You got 8:20, 8:30, 9:30 manipulations, man. And that's why I said, okay, go look at the bond's opening range. How many times is the bond's opening range the wick of a daily candle? So what I'm saying is there's a lot of manipulation there. We already know that. But when you look at it through a different perspective, okay, well, this hour, we're not looking at it just in macros and because we got the 8:30 macro, 8 o'clock to 8:30 macro, I believe it is, right? And then we got the 8:50. Those are the intricate inner workings of literally the algorithm playing around with the PD arrays that are already set in motion, which are the PD arrays within the bond's opening range. So what I'm telling you is, just as you approach IPDA in the higher time frame as a look back, you're looking back to a PD array, or you're looking back to a liquidity level. That's the bond's opening range. Because the bond's opening range, as soon as it's over and done with, you're going to have a look back function. And the market likes taking out its highs or lows in terms of liquidity after the bond's opening range. And then your 2022 model could come in, or whatever. But what we're doing is we're focusing on the volume of the market in terms of PD arrays, right? Because that's high probability. So the high probability PD arrays are going to have a relationship within the PD arrays that have that relationship that are high probability is going to be the bond's opening range and the PD array that is to follow after the bond's opening range within that area of the range, right? So if you look for the 2022 model, every time, after the bond's opening range, and you're like, okay, we purged the highs, I'm bearish, I see that there's a breaker here. Okay, that breaker, what PD array is within the bond's opening range that you also want to see respected, right? Because that's where the volume is at for the bonds market. And those PD arrays the bonds market, it respects those PD arrays a lot. Like, there's less fuckery there, basically, is what ICT says, right? There's less bullshit within those PD arrays that are created within that hour. They're respected more in the bonds market. Now, the bonds market does have a relationship with the overall market, right? And the algorithm within the NQ and ES is gonna show that. That's why the algorithm likes to take out the liquidity on either side of the bonds market opening range, because it's obviously working within those with it, has a relationship with it. Just give me a second. Then you understand that that's literally the range with the P arrays that you focus on, right? Because it's like, okay, I understand standard deviations for, like, okay, I got a target, right? Yeah, okay, I want the target 2.5, a close above 2.5, which is something I fucking shared a long time ago. For a lot of people who don't know, right? I've shared this shit 2 years ago. And I told this person, hey, go look at what happens when we close above the 2.5 standard deviation, and then tell me what you see. He's like, oh, fuck, what the fuck? I'm like, yeah, there you go, bro. So then you got everybody talking about 2.5, right? As a matter of fact, I deleted that tweet when I told Dexter. I'm like, go do this, bro. Go check it out. See what you see. And then I deleted it. I was like, I don't want these fuckers I want to see if he caught that shit. And yeah, he did catch it, because I deleted that tweet. He had posted something on standard deviations. I told him, let me give you a little hint. So obviously now people are like, oh, the close above the 2.5, that's awesome, right? Because I have been fucking with standard deviations. So if I tell you I don't fuck with standard deviations, it's for a reason, bro. Because there's a higher level of understanding, bro, which is what I'm fucking showing you, which is simplifying, which is you just got to understand which PD arrays and why, right? Because the fractals are, okay, there are fractals within fractals, and let's say just focus on NQ, right? There are fractals within those fucking fractals in those algorithms have a relationship with the fractals as a ghost in other fucking markets. So what I'm saying is that the bonds market is like a ghost within NQ, because that liquidity is still represented in there. The representation of the bonds market liquidity is within the NQ candles. There's a representation of the bonds market in there. The bonds market is being expressed. It's expressing itself within the overall market. And that expression is going to start a relationship with NQ. So let's say that's why it's called the bonds market opening range, because that liquidity, I'm focusing on a market that is outside of NQ, but that is represented and it's expressing itself as liquidity in NQ, because NQ's You need something to look back towards for direction. The algorithm's like, okay, where do I go from here, motherfucker? And the bond market is like, hey, I got this shit right here, bro. Don't trip. So it's like the NWOG. Oh, where do I go from here, motherfucker? Well, NWOG's like, bitch, I got you. And there you go. So you start understanding where the magnets are. What are magnets? It's fucking, it's volume, guys. So if the BOR and the NWOG is volume, all right, what are you supposed to think about the bodies that are created within that fucking, those ranges? Because the bodies tell the story, right? So then, therefore, you can say that those bodies of those PD arrays that hold that much fucking volume are completely different than any other PD arrays within any other areas of the market. They have a relationship with each other, but now you're pairing, you're literally like narrowing it fucking down to the meat, right? Like the fucking meat. So now you understand that those PD arrays in the bonds market opening range are a motherfucker. Just go look at those ranges every single fucking time. And what I mean by a motherfucker, I mean they've got the volume. When those PD arrays, bearish or bullish, are violated, that's a big fucking deal. Okay? And when they act as support, it's a fucking big deal. Therefore, if they are heavily supported with volume as support, your fucking stop loss, if it gets taken out, you're definitely on the wrong side of the fucking market. Which is good. It's good for you to find out, right? So if you were to use the bonds market opening range as a high probability trading range, and you know how to read PD arrays and what it means when a certain PD array gets violated or respected as support, then your target is the easiest thing ever. Because all you're targeting now is the nearest high. Liquidity levels. Where are the shorts that are in fucking profit right now? That's the first thing that's your low hanging fruit, right? So this is called simplifying it. Now you don't have all this shit on your chart. You know where the volume is at. And EMA ain't gonna tell you where the fuck the real smart money is at. You need to know where the fucking smart money is at. It's called you're stalking the dealer, okay? So when you have a range that has a lot of volume with significant PD arrays that will act as support or resistance, you're stalking the fucking dealer. You're not running around with all this shit on your chart because you know how to read what? Price action. You don't need anybody to fucking tell you that bonds market opening range is where the meat is at, where these motherfuckers smart money's going to say, all right, this is where we're going to push it away from. Like the NWOG, right? There's going to be a thrust, a push, volume, expansion away from the bonds market opening range. You don't need all that shit. All you need to understand is where the fuck shit happens and why. And it's always time. Because that's where they decide, and okay, here it is. This is the shit right here. Go look and study the bonds market opening range, and then you're going to understand what the fuck I'm talking about. Now, you want to use standard deviations and all that shit, that's up to you. That's fine. No big deal. But don't be focusing on, oh my God, standard deviation. No, you need to understand where the fucking why, bro. You could be using the standard deviation in every fucking range. It don't mean shit. It matters where you fucking use that standard deviation. You got to use it where I understand, this manipulation at 9:30, and that's beautiful. That's beautiful, right? But there's more to everything, right? So the standard deviation, it's there. It's always going to be there. But if you study the volume in price action and where smart money is at, then that's even better for you, right? Because now you could just simplify it and be like, what time is it? Oh, 7:30. Oh, babe, check it out. Bonds market opening range is opening up right now real quick. Let me check it out, babe. And then you're like, oh, PD array. You just mark that one fucking PD array. And you're like, oh, it's being respected, bruh. And we got an FVG at 10:15, bruh. And we got this fucking discount bullish order block, bruh. If I'm bullish, bruh, both should be fucking respected, bruh. And then you just enter there. And you just go, all right, bro, we got a unicorn, bruh, let's go. Right? And then that's it. You don't have to use none of other shit. You don't have to fucking be studying a whole hour or 2 or 3 or 4. You just know where the fuck the job of the bonds market opening range is. It's to send price either higher or lower, and that's it. And that's it. Regardless of your fucking bias. Period. There it is. Study that. Study it as an analog. Study it, the PD arrays, and understand that there's going to be an expansion away from that range. And study the violation and or respect as support of those PD arrays. And with that, I'll just let you guys go. I got to go. Sorry, guys. Bye.